CNBC-TV18.
The second quarter growth at 6.3% is in line with the Reserve Bank's forecast. But here are some positive and negative takeaways, if you will. The GVA, gross value added, is up only 5.6%. So is the economy not as strong as the GDP is indicating? Could be a worry. Agriculture is the best factor, robust at 4.6%, but manufacturing is shockingly weak, coming at a negative 4.3%. Services as a whole is generally strong at 9.3% growth, largely because of this one element, trade, hotels, transport category, growing at 14.7%. But in absolute terms, this sector, trade, hotels, transport, communication, is only 6.5 trillion rupees in size, the same size it was in the year 2019. It's also a huge employer. So, a bit of a worry that it's stagnant. The other positive, private final consumption expenditure and capital formation, both are very strong, double digits growth. On the other hand, government expenditure is surprisingly weak, minus 4.3%. Maybe states didn't spend and they will start doing so in the second quarter. So that's the picture. One more factor that we need to remember is net exports. Imports have grown much more than exports. The net imports is like almost half what it was, is almost double what it was a year ago. That is a drag on the GDP. Important to end this discussion, the chief economic advisor, when he analyzed it, said that India is on track for 6.8 to 7% growth. RBI's forecast is 7%. Looks like the consensus is now veering towards a sub 7% growth. Is it? Would be a question. But let me ask the experts. We are joined by Upasana Bharadwaj of Kotak Mahindra Bank, Abhishek Upadhyay of ICICI Securities, PD, Mridul Sagar, former MPC member and former executive director at the RBI. And we're joined by Soumya Ghosh, the chief economic advisor at State Bank of India. Welcome to the show, gentlemen and Upasana. Let me start with you, Mridul. GVA coming in at 5.6%. Is that an indication of some weakness?
It is a sign of weakness, but the headline has to be seen in terms of the GDP. So there are two things here. The way the Indian data is collected, the GVA numbers are a lot more firmer than GDP numbers. So you're right in saying that there is a slight worry. Standalone, I think the data release yesterday is neither disappointing nor a cause for enthusement. Basically, it's a very much inline number. It's signaling the kind of slowdown everyone was anticipating. So that slowdown seems to be coming. It's coming globally. It's coming less in India. In India, the domestic factors have also driven the growth down.
Okay.
So that is the main aspect of it.
Okay.
Yeah.
Let me toss the same thing to Soumya as well. Soumya, the GVA plus taxes minus subsidies is GDP, and GST collections were very good. So this 5.6, as Mridul says, if that's the real economy, then it's looking a little worrying. Secondly, we also got the core sector numbers for the next month, October, and that was shockingly weak at 0.1. So is there some worry about the quality and quantity of pace of economic growth?
Yeah, good morning, Lata. I think the GVA numbers at 5.6% was a little higher than we were expecting. So, and the gap between GDP-GVA at 70 basis points is actually a little bit on the higher side, but that was expected given the very robust tax collections. So that's point number one. The second point which I'd like to mention is that if you look into the data very closely yesterday, you will find that the inventory deaccumulation has been very strong. That means the producers are still getting of the inventory which had accumulated during the pandemic and afterwards, and maybe that's the reason why the core sector growth has not been so strong in terms of new production.
Okay.
So that's an indication that the supply bottlenecks which were there has been resolved, and new inventories and capacity utilization will get added in the subsequent quarters, because yesterday also the bank credit growth which came in was continued to be very strong. So if I take all these factors into account, yes, the data is in line with market expectations, and there are some positives, some negatives, but largely I think the positives of agricultural growth rate, trade, hotels are very comforting factor in the data released yesterday.
Okay. Well, then let me flip the question into positives and ask Upasana that. Upasana, if you looked at it from the expenditure side, strong double-digit growth in private final consumption expenditure and investment, consumption and investment. Does that mean there is an upside bias?
Now, I think, Lata, here, these two components are definitely very comforting. One is on the private capex side that we're talking about, not necessarily private, but it's more led by public focus of infrastructure, I think, at this point in time. The private capex is still in its nascent stage, and we do expect some benefits arriving from there in the subsequent quarters. But for now, I think it will be more public-led. Private consumption is something which has held up quite a bit, even on a sequential basis. If you look at both these components have been quite robust. My only worry is, as we go ahead, how much will this sustain? As of now, if we were to compare the financial savings of the household sector, they have held up well, and the buffers that they had built up during the pandemic, they were still existing. In the quarters ahead, my fear is that these buffers would be subsiding, and I don't know how long will we be able to sustain the private consumption story. So unless overall there is a ramp up of private capex, more money in the hands of households, there might be a slight slowdown going ahead on the consumer's pocket.
Okay. Abhishek, I wanted to ask you about this K-shaped recovery. You know, of course, trade hotels is 14.7%, but like I was explaining initially, it's also static in terms of the total output, 6.5 lakh crore. That was the number 6.39, if I'm not mistaken, in 2019, that is FY20. That means, and that's labor intensive, isn't it? So is there a worry that consumption is strong, but it is in the upper echelons?
Yeah, Lata, first a quick point on GDP-GVA split you mentioned. So this number was important because this will have a significant bearing on the first advanced GDP estimates that we'll get early next year, and that will have significant bearing on the budget math both for this year and next year. So this comes as a relief. And on core sector numbers were weak, but then differing time of holidays you have to take into account, and that may be exaggerating the weakness. On your query about K-shaped recovery, we should see progressive resolution of that issue. I agree, it is still a problem, and you can see that in the high frequency indicators as well. The passenger vehicle sales are doing much better compared to the two-wheeler sales. And within passenger vehicle sales, the entry-level segments have done much poorer compared to the other segments. So that is still a problem, but there has been some resolution. So two-wheeler sales are now close to pre-COVID levels after a steady rise that we have seen over the last few months. So I think what is happening is that as these contact-intensive services come back and start to do normal activity, and you mentioned because these are high employment-generating sectors, this trickle-down will slowly revive consumption in that part of the economy. The other bit is, I would think inflation slows down slowly but steadily over the course of next year. That should be positive from consumption standpoint as well. All in all, there are risks to consumption outlook because the primary drivers, exports and private capex are still not. The risk is to that those growth in those segments will be on the lower side. But then easy fiscal policy, neutral monetary policy, and progressive resolution of K-shaped recovery should be positive for consumption.
Okay. Well, I'll come back to this K-shaped again because for the stock markets, it would still mean that they should prefer consumer discretionaries over consumer staples since, you know, the upper part of the K seems to be doing well. But let me just take Mridul on exports as well. If I subtracted imports minus exports, Mridul, the difference is double what it was same time last year. Clearly, if we are the one good story in a weak world, others will also try to stuff their exports on us and increase our imports. Is that a worry?
It is a worry. I mean, clearly the current account deficit was widening in the first half of this year, and that has shown into the national accounts data as well. Going forward from here, it is even more important to see how this works out, because global exports are slowing, and which also probably means that India would have less opportunity to export. Whereas if growth stays high, the imports would stay high. But if growth in India is also slowing down, then probably the current account can adjust a little bit better. In terms of the width of the numbers, I think the second half would not be wider than the first half in terms of the current account. So I'm not that worried that the growth would just collapse because of external factors. What we need to focus more is on internal factors in trying to keep investment high. The consumption is staying reasonably robust, and given the agriculture data we have seen here, there's no cause for despondency. The credit growth is also picking up, but the credit growth is picking up essentially because of inflation effects and the elongation of working capital cycle because of disrupted supply chains, whereas also CapEx is beginning to improve a bit, but not something which is kicking off in a very big way.
Well, Mridul is sounding a little iffy. Growth is likely to be good, but exports will be a challenge. And there is a bit of a problem even at the bottom of the pyramid, consumption. We will thrash the future growth trajectory with our experts in just a minute after this very short break. Welcome back to this special Indianomics on the second quarter GDP numbers. We have, of course, since got a few more numbers. We've got the core sector for October. We've got auto sales for 2 months. So we have a slightly clearer idea of growth. I've been speaking with Upasana Bharadwaj, Abhishek Upadhyay, Mridul Sagar, and Soumyakanti Ghosh. Gentlemen and Upasana, thank you very much for staying on. Soumya, before we went into the break, Mridul was speaking about both sides, positives and negatives for growth. Let me start just with the capex cycle. As he points out, the capex cycle, the credit growth could be higher because everything is more expensive and working capital cycles are longer. Will you be convinced that the capex cycle has started?
I think, Lata, it's a mix of both factors. While we can't deny that the working capital cycle has got elongated, but we also cannot deny the fact that there has also been a significant demand for term loans. So an important thing is that if you very closely look into the data, the aggregate scheduled commercial banks data for the month of October, which was released yesterday, which shows a significant uptick in the credit growth to industry. And please note that inflation has actually started to decline post-September. So that indicates that there is an element of term loan component also in the credit, which is being disbursed. So while I agree with the fact that, yes, there could be some amount of working capital, but the important point is that the term loan component has also been strong and it has picked up in the last month of October. So I think so that actually augurs well for the future investment climate.
Okay. Upasana, will you be convinced? I mean, I'm asking analysts, economists who are also with the bank, and therefore you would have some anecdotal evidence as well. Consumption has grown, but FMCG companies tell us that volume growth is still in low single digits. Uniformly, all those who are serving the rural market bemoan the weakness in rural demand. Tractors are good, but the lower level, they keep worrying about rural demand. The agri numbers don't indicate that, but that's what the people who are selling to rural markets tell us. And if there is no demand, will there be capex? So again, the capex cycle question, where are you?
So Lata, number one, I think anecdotally, when we're speaking to clients, we are getting the similar feedback wherein they are concerned on the rural demand. Whichever category we're speaking to, they do remain concerned on the rural demand that seems to be fading lately. Secondly, on the capex side as well, we have been talking very rigorously with our clients, and we do realize that there is a very similar K-shaped argument that we are finding there as well. the MSME segment is seemingly postponing their decisions on capex because they're not very clear on demand. They are feeling the brunt of slowing exports. So that segment is very categorically denying any possibility of capex. While on the other side, we have the much larger clients who are probably much more comfortable, much more cash rich, and hence they're still relatively far better off and thinking of expanding. So I think this entire organized segment that we're talking about is relatively better, and we will see some progress there. And just to add to what Soumya said, it's not just the October reading, but also the September and October, both the 2 months. After a long time, we've seen a reasonable pickup in the credit offtake to the larger corporates. I think that's one segment which we need to observe closely. That seems to be picking up beyond just the working capital requirements. So it's maybe the early stage, but we'll have to wait and watch for the larger corporates, which is probably gelling with the fact that the smaller segments will be weaker, but the larger ones will probably be able to hold on to the capex cycle.
Okay. No, your point is taken. Even in the Q2 numbers, there was while retail loans are still the highest. Almost all the banks, many big banks we spoke with, were indicating higher corporate loans than in the previous quarter. So certainly the trend has taken off. Abhishek, just to wind up the external sector argument, is the worry on the external sector and rupee any less? It looks like yields have peaked off globally. It looks like crude oil prices have peaked off globally. So do you think that even if imports are much higher than exports, financing it won't be an issue?
Well, global headwinds have clearly eased. So crude prices have come off, you mentioned, and importantly, dollar has continued to weaken despite a reasonably hawkish Fed rhetoric. And dollar is critical for emerging market policy making. In terms of what it implies for the CAD, I do think CAD will come down in the second half of the year and into next year as goods demand slows down and as this terms of trade shock fades away. But the worry for me is that, for instance, next year we're looking at 2.5% CAD, but in absolute terms, that will still be close to 100 billion. So financing that will continue to be a challenge unless we get a one-off spurt on the capital flow side because of FPI flows, for instance, which could be in turn triggered by bond index inclusion. So unless we get that, I think on the BOP side, unless we get a really sharp slowdown in growth faster than what we are currently anticipating in India, I think financing the current account will be a worry, but dollar weakness and neutral dollar could be a big tailwind.
Okay. Yeah, okay. So perhaps the fears of the 85 are not palpable at the moment. Now a rapid fire round, or 2 rounds actually, if you guys don't mind. Let me start. First would be a growth question, and the next would be an RBI rates question. First, to start with you, Soumya, what's your full year GDP growth, and is there an upward bias compared to, say, last month?
Yeah, we had actually put in a GDP forecast of 6.8%. There could be a possible upward bias because the leading indicators have been strong in the months of October.
Fair enough. I'm sorry, I'm trying to make it a rapid round. Mridul, how would you estimate growth?
For the full year, 7% or marginally less than that. Okay. So this broadly on the earlier expectations.
Okay. Since I have the liberty, a very quick, do you think we will be able to sustain the pace, Mridul? For 24?
I think no, but we are not going to fall off the cliff. Okay. The deceleration will continue into next year, but we will not fall off the cliff. We'll actually be outcompeting the peers.
Oh, still the best story in town. Abhishek, full year?
7% this year, 6% next year, downside risk to both the estimates.
All right. So basically all of you are somewhere sub 7, perhaps. Upasana?
6.8 this year, Lata, and next year 6% with a downward bias.
Okay, that's some unanimity in terms of expectation. Reserve Bank on December 7th, Upasana?
35 basis and probably a pause thereafter for a while.
Abhishek?
35 basis, no change in stance.
Okay. Mridul?
I think I'll go along with the panel. Not that I should put out a number very strictly, but there is a case of a smaller hike, but continue the hikes so that we move into the positive real deposit rate terrain.
Okay, fair enough. Shaumya?
At most 35 in December.
Okay, that's a great deal of consensus across the panel. Thank you very much, Upasana, Abhishek, Mridul, and Shaumya, for reading the tea leaves in terms of growth and for some guess on what the Reserve Bank might do. Looks like this time it's priced in that the 50 basis hikes are behind us. That's all we have time for. Thank you very much for watching this edition of Indianomics.